Ladies and gentlemen, welcome back. This is Christopher Aaron. This is the iGold Advisor channel. It is September 9th, 2020. We're going to focus this week on what I believe is one of the most important things for us as precious metals and also as cryptocurrency investors. I know there are a lot of you out there. A lot of our clients are both precious metal and crypto investors. What is one of the most important things that we should be focusing on right now is the possibility of a US dollar crash coming into the later part of this year or into 2021. And we have evidence to support this. This is not just going to be a lot of hyperbole here. We're going to take a look at it. And the most important reason for that is what we saw a little over 1 week ago at the Jackson Hole, Wyoming Federal Reserve meeting. So what I actually want to do here, this is going to be a bit of a special video for a couple of reasons. Number one, we are taking the next few weeks off here. So you won't see any videos for the next several weeks. I am taking some time off. I am traveling to an undisclosed location where I will be taking some vacation. And let's see if any inspiration strikes while I'm there. Sometimes you need to step away from the markets for a little while to refresh your perspective on many things. So if some inspiration strikes, I will record an ad hoc video on the spot. Otherwise, this will be the last video for the next several weeks here on the free YouTube channel. We will have more premium content coming out for premium subscribers. But so what I want to do in this last video here for the time being is to share with you a portion of the premium subscriber video that just went out a little over a week ago covering this topic of the US dollar crash, what we see setting up, what the Federal Reserve is engaged in, how this is going to be impacting the precious metals. It's quite an in-depth segment. It's about 20 minutes coming up here. As you know, we like to do in-depth analysis on this channel, so I hope you'll stick around and watch it. So this is for free. It's coming to you. That segment, stay tuned, and then after the video, I will be back here with some closing remarks before we wrap things up here before taking our break for the next several weeks. Here we go. So let's cover the Federal Reserve meeting here, which was held in Jackson Hole, Wyoming this week. It was on Thursday morning, and it was quite a volatile trading day that day on Thursday. We'll look at that all in the global asset comparison coming up. But let's cover just a few brief takeaways here from the Federal Reserve statement itself. This was by Jerome Powell, the head of the Fed. So the most important thing about this update is a new policy, which was issued by the Federal Reserve called average inflation targeting. And average inflation targeting states that the Federal Reserve will allow inflation to sometimes run moderately above its 2% goal, following periods when the inflation level has run below that objective. So in other words, they're not only going to keep it at 2%, but sometimes they're going to allow it to run moderately above 2%. Now, they have not defined what moderately means. Does that mean 2.1% or 2.2%? Does that mean 2.5%? Does that mean 3%? Does that mean 5 or 10%? If there's a couple years below 2%, they have not defined what this means. I'm just taking the text here basically from the speech itself. So there's a lot still that's unknown. And now I want to read a few of the most important quotes by Jerome Powell here. Many find it counterintuitive that the Fed would want to push up inflation. However, inflation that is persistently too low can pose serious risks to the economy. Now, I want to remind you of one thing before we go any further. It was only in 2012, it was only 8 years ago, that the Fed ever adopted an official 2% inflation goal. Before that, the Fed had two mandates. The two mandates of the central bank were for stable prices and low unemployment. So they use that word stable prices. They never said that there was an official policy of any level of inflation prior to 2012. So then all of a sudden in 2012, they come out and they say, now officially, as opposed to using the term stable prices, we are going to say that we have a goal of 2% inflation. So just keep this in mind. This is only 8 years that we've had this goal. And now they're already pushing it up even further to say that if we fall below this quote-unquote goal for the last 8 years, now we can achieve inflation which is above that. So here they're talking about, inflation that's too low can pose risks for the economy. Let's look at one other quote. Inflation that is too low can lead to an unwelcome fall in longer-term inflation expectations, which in turn can pull actual inflation even lower, resulting in an adverse cycle of ever lower inflation and inflation expectations. I don't know how else to say it, but this is just absolute baloney that we are hearing here out of Jerome Powell and the Federal Reserve. The idea that having too low inflation is a bad thing needs to be completely thrown out of the window. This is total malarkey. This is total BS. Nothing could be further from the truth. Low inflation or outright deflation is the natural state of a monetary system that is not meddled with by a central bank. Deflation in which prices of things become less over time because the purchasing power of money increases over time. This is the natural state of an economy in which the Federal Reserve or a central bank does not interfere. Let's look at some examples. Let's just think about it for a moment. Think about flat screen televisions. Go back to the year 2000. High definition televisions cost $10,000 or $15,000 for a 36-inch flat screen TV. Now you can buy a 60-inch flat screen TV for about $500. Okay, so 1/20th of the price. That's how far prices for flat screen TVs have come down. Why? Because we as human beings become more efficient and more productive throughout time, and we produce things for less cost, and therefore cost comes down. That is the natural order of things. It is only in markets in which the Federal Reserve is meddling in which prices go up over time. And why does that happen? Because they print more money and they divert that money to certain markets that they are trying to support, such as the stock market, such as the bond market, such as equity values for their favorite institutions. And we see these prices going up over time. It is not the natural state of an economy for prices to rise over time, except in very, very rare occasions. We might look at antiques or we might look at unique collectibles as being exceptions to that. So the idea here that they're proposing is completely false, that lower long-term expectations are negative for an economy. This is false. You can look at examples going back, especially look at the Industrial Revolution, when the United States was on a gold standard. Let's talk about the period after the Civil War, when the United States and Great Britain, for example, and most of the developed world was on a gold standard, right? The US dollar was backed by gold. It was $20 to buy 1 ounce of gold. In other words, the US dollar was convertible into 1/20th of an ounce of gold. Think about all of the inventions that happened in the years just leading up to the Civil War, 1840s through the 1870s, what they call the Gilded Age. Think about all the inventions: the railroad, the radio, the predecessors to electricity, the predecessors to the automobile, and eventually in the few years after that, the airplane, right? So many inventions that totally changed the world forever came from a period of time in which we were on a gold standard, and throughout that time, prices fell. Prices for things, generally speaking, fell throughout this time, and the value of money increased. This was not an impediment toward human progress, as Jerome Powell and the talking heads in mainstream economics now proclaim, this was actually the backdrop for a healthy economy. Because when savers are rewarded, when you are rewarded intrinsically for saving money by the power of that money increasing throughout time, this is something that is very good for the broader realm of human activity. Okay, it is not healthy for human progress when savers are punished and they have to go out and speculate in markets to try to avoid having the purchasing power of their savings robbed from them. That is not healthy, as the Federal Reserve is claiming here. So there are countless examples of this throughout history, that inflation is not a good thing, but we live in an upside-down, backward world right now in which the Federal Reserve basically, and everyone who's only begun to study economics after 2012 when they adopted this 2% inflation goal, now this is almost what anyone remembers at this point. So everything is flipped on its head, but this is the world that we live in. Still, as investors, we have to try to cut through this baloney, and we have to protect ourselves, and that is what we are doing right now. And we can see exactly what the outcome of this was here for the week in sum, and especially looking after Thursday morning here, August 27th. Jerome Powell began to speak at 8 a.m., and then we have this peak here in the dollar, and then the dollar losing about 1% of its value over the next 2 days. And gold, it's tough to see here. A lot of lines were overmixed here, but gold actually sold off immediately following that. That gave us a little false breakdown in the gold market, and then gold recovered. Same thing happened for silver. Silver recovered. Gold miners recovered. Oil and commodities recovered. And what? Industrial stocks, technology stocks, etc., all recovered. So the major thing to make note of for this week was the poor performance in the U.S. bond market. I mean, down 3% for the week, down 2% alone from Thursday morning here. We had seen over the last couple of years, we had seen many occasions in which the U.S. dollar would sell off, but illogically, investors would move into bonds. It was almost like investors were saying, yeah, we don't want dollars now, but we want dollars in the future. We did not see that this week, and this is a major shift in behavior in the markets. And if this kind of thing continues, I'm going to save this for the next couple of weeks, but those who have been with this service for a long time know that the bond market has been rising steadily for 40 years. That's not a misstatement. 40 years has the bond market been moving higher. And we've had this thesis for a long time. We've been waiting to see, when is the bond market finally going to crack? When is it not just going to be dollars in the present, but investors for dollars in the future, which say that's enough. Enough games out of the Federal Reserve, enough games out of the European Central Bank, because obviously it's not just the Federal Reserve. I think we can pretty much guarantee that the Bank of Japan, the Bank of Europe, the Bank of England are all going to begin adopting these official inflation targets and then look to try to overshoot those inflation targets over the years ahead. So I never want to come across as if it's only the U.S. Central Bank which is making these blunders. But over the short and intermediate period, we did see weakness in the U.S. dollar, and this will bring us to the longer-term perspective. Let's bring it back since the start of the coronavirus. This was the pre-coronavirus stock market peak, as we were calling it. Major collapses in everything leading into the March bottoms, followed by the recoveries, which we can see industrial commodities performing the worst here out of the recovery. And that makes sense because, we're seeing the world economy change in front of us. I mean, how many people, I have a lot of colleagues who are just not going back to their offices at any point within the next year. They're going to be working from home pretty much forever. So think about the lack of demand for oil, the lack of demand for gasoline that's causing. Multiply that by a few billion, and you start to get the idea of what's happening here in the oil market, why it's lagging. For example, silver, which is still 80% used by industry, Yet, we are starting to see the demand come in at the margins, which is the most important demand. The demand at the margins, which says we want silver for its monetary component. The thesis, by the way, is that at some point in the middle part of this decade, it could be 2024 or so, there will be a nice rotation to be made when we get towards some of those much higher targets in gold and silver, and it becomes time for the industrial commodities to begin to play catch up with the precious metals. That's on the future. I think industrial commodities will rise somewhat with inflation, but they're also going to lag due to the continued impacts of the coronavirus, the changes that are occurring around the world, even as we speak. Very nice to see the precious metals and the gold miners leading out of the coronavirus panic. Let's move on and look at the dollar. We were just talking about this. Here it is. We are about to witness a major breakdown, a major trend shift in the U.S. dollar. And as we said before, talking about the Federal Reserve compared to other central banks, keep in mind that when we're looking at this U.S. dollar index, you can see right here up at the top from 2004 to the present, the U.S. dollar index compares the U.S. dollar versus a basket of other currencies, which is heavily weighted toward the euro. The euro makes up over 50% of the dollar index basket. So keep in mind, this is not an appropriate long-term measure for how gold is going to perform, because it's quite possible that throughout the course of time, the dollar merely oscillates. Perhaps the dollar has 10 good years versus other currencies, and then 10 bad years versus other currencies, et cetera, into the future. And that is a net sum. All the currencies are losing value versus gold. This is the thing to remember. So we're not hyper-focused. There are some analysts who are hyper-focused on the dollar, who basically the dollar is the only thing that they focus on. Is the dollar losing value, therefore gold should rise, or vice versa. We're not in that camp here. That said, over the intermediate term and over the short run, a loss in the value of the dollar can have indeed a significant impact on the psychology of traders and investors who are looking for protection from that. And then they move into gold and other tangible assets. So we've been talking about this here, that the dollar had been below the best fit. And remember, the darker the line here, we're talking magenta, the solid line, right, is more significant than the dashed line, according to this key. And we really try to plot these charts here with a lot of accuracy, a lot of precision. And so the best fit line, if you look at how this goes back to the 2011 bottom for the dollar and kind of skirting these lows here in 2013 and 2014, why? Because then we get a very nice hit here with the 2017 and 2018 bottoms. That line had already been broken. It was the more significant line. And I had made the case that when we had seen that breakdown, this was just 4 weeks ago, that the dollar, to use the funny analogy, that the dollar was basically in the land of this Wile E. Coyote from the Looney Tunes, where it was already over the cliff. It's just that it didn't realize it yet. And you basically had some traders, some investors here who were just buying the dollar for any old reason, not realizing the significance of the trend break that we had already seen 4 weeks ago. And it looks like when we zoom this in, here are the last 4 weeks. It looks like when we zoom this in that we can see that the dollar, look at the attempt at a recovery here. We were talking about this 2 weeks ago. So we had the attempt at the recovery, now a broken trend, and you can see the rejection on the broken trend. And now we are declining again back to that 92 level here. This short-term look at the dollar is ugly, ugly, ugly. There's nothing positive to say about this chart right here. It looks like it is getting ready to slice through the 92 level, which is that lower absolute lows, but the less important trend going back from the lows here. And what we've been saying is that when this 92 level is broken, that the dollar is going to fall to at least 88. This level here, 88 and change, this black double line going back to this bottom from 2017. And you might say, well, that's only from 92 to 88. Yeah, but remember this. I mean, we're talking about, that'll be something like close to a 4.5%, almost a 5% drop in the dollar. This could happen in a matter of weeks. This would be a fairly significant drop in the value of the dollar in a few weeks, and it could very well serve as the backdrop for that move in gold to somewhere above 2140 and perhaps even approaching 2400. So we are literally, I mean, as this video is being recorded, we're looking at it, and the dollar basically looks like it's got nothing left, and it's getting ready to slice through the 92 level, which is right there. And from there, we will see that decline. We will see that decline to 88 and change. We will then see the big counter trend rally on a highest probability basis. This should be that major correction in gold and silver that we're anticipating for either later this year, perhaps extending into the first half of 2021. And then that will be a false rally for the dollar before a new bear market trend will begin lower, which will bring us to some of those long-term outstanding targets higher for both gold and silver. So I just wanted to bring this up. We talked about the Federal Reserve, this new policy. Really, it's only been an 8-year-old policy of even a 2% inflation rate. And now we have them saying, we might go above that. We're not even going to tell you how high we're going to go, but somewhat above that 2% level. And look, it looks like they are going to succeed in slicing significant value off the purchasing power of the U.S. currency. That is now being confirmed in the dollar chart itself. So there you have it, guys. This is sheer insanity that we're seeing out of the Federal Reserve, sheer lunacy. They are stealing from savers. They are giving that money to their favorite institutions. But you know what? The best thing that we can do is to protect ourselves from it. If we're going to have an abomination of a central bank, which is what we have, then we should at least protect ourselves from it. So that is why we are here. We're trying to alert people. We're trying to make sure that people are aware of what is happening behind the scenes and trying to show it to them in the most clear manner possible, which is through a visual study of the actual price data, not just through talking about it. If you like this kind of video, I do want to let you know I work with individuals by voice and email consultation. We are on wait list only until September 21st, until we return from our holiday. You can find more about signing up for that for the wait list, and we will get back to you when we return. If you would like to receive in-depth videos such as you just saw, but not just 20 minutes long, usually 45 to 50 minutes long, and not just every other week, but every single week, this is the service that goes out to premium subscribers of Precious Metals Intelligence. You get videos just like this covering not only the U.S. dollar, but gold, silver, the U.S. stock market, the commodities market, the gold and silver mining sector, every single week for 50 weeks out of the year. This also includes the exact gold and silver miners that we are buying and selling right here with flash updates right to your inbox when we make those decisions. So make sure to check out the homepage to either sign up if you want to work with me one-on-one, or if you would like to receive our premium analysis service, Precious Metals Intelligence. This is the time to be doing it while these metals are consolidating. I want to make sure you hit the subscribe button so you'll be notified when we get back from our holiday break here. As I said, I'm going to see what sort of inspiration strikes. Sometimes when I step away from the computer screen for a few days, the best way I can describe it is that things start to come from another perspective, from another dimension, if you will. Maybe it's another side of our own minds. Maybe it's when we connect with nature. Maybe it's when we connect with other aspects of the world or the universe around us. It's hard to know all the time. All I know is when I get away from the desk for a little while, that's when new perspectives really start to pop up. And so if there is the opportunity, I will post a video for you with some of those thoughts as we are away from the screen. If not, the next update here on YouTube will be several weeks from now, and the next update for premium subscribers will be coming up in 2 weekends. Thank you very much, and I will see you soon. Stay well, stay healthy, and stay strong.